Oil prices don't usually whisper before they move. They roar. They spike. They crash. And yet, for nearly a decade, the global oil market behaved strangely, drifting upward, collapsing suddenly, then recovering with unsettling precision. Traders blame geopolitics. Governments blame supply shocks. Ordinary people blamed inflation, wondering why fuel costs seemed to rise no matter who was in power. But beneath the noise, something quieter was happening. A pattern few noticed. And one person understood far better than anyone else. What if the biggest swings in oil prices weren't driven by wars or shortages, but by a single trader operating in plain sight? What if the most important force shaping energy markets wasn't a nation-state, but a human being who learned how to bend the system without breaking it? This story isn't about a dramatic crash in a single afternoon. It's about patience, about leverage, about understanding how modern financial markets actually move, and how fragile they can be when someone learns their hidden rhythms. For investors, this story became a lesson written in losses. For governments, it raised uncomfortable questions about oversight. And for millions of families, the consequences showed up quietly at gas stations and grocery stores. If stories like this fascinate you, subscribe and join us as we uncover the hidden mechanics of global finance. And tell us, what country are you watching from, and how closely do oil prices shape your daily life? Because once you see how this worked, you'll never look at energy markets the same way again. Long before regulators noticed anything unusual, the warning signs were already there, scattered across terminals, buried in trading volumes, dismissed as noise. In the early 2000s, oil markets were changing shape. Futures trading volumes began to dwarf the physical barrels moving across oceans. Paper oil, not crude itself, was becoming the real force behind prices. Most investors welcomed this. Liquidity meant efficiency. Or so they believed. Inside this transformation, one trader saw something others didn't. Not chaos, structure. Patterns forming where human behavior met algorithmic systems. While hedge funds chased headlines from the Middle East and analysts adjusted models around OPEC meetings, this trader focused on timing. On how prices reacted not to reality, but to expectations of reality. A subtle distinction. A powerful one. Early on, the trades were small. Almost forgettable. A cluster of futures contracts here. A sudden withdrawal there. The market absorbed them easily. But something odd kept happening. Prices would drift in one direction without a clear catalyst, hesitate, then snap back violently. Journalists speculated about supply rumors. Analysts blamed thin liquidity. No one connected the dots. Ordinary citizens felt it differently. Truck drivers noticed fuel costs rising for no clear reason. Airlines quietly adjusted forecasts. In boardrooms, energy-intensive companies exchanged uneasy looks as hedging costs crept higher. Nothing was breaking. Nothing was illegal. And that was the point. Behind the screens, the trader refined a strategy built on pressure, not force. By accumulating positions slowly, spreading exposure across exchanges and time zones, the trades never looked threatening. Yet together they nudged sentiment. Triggered algorithms. Invited momentum traders to follow shadows they didn't realize were planted. The market was still calm. But it was no longer neutral. And just as confidence settled in, the trader made a decision that would change everything, scaling the strategy beyond what the market had ever quietly tolerated. The shift wasn't dramatic. There was no sudden bet that screamed manipulation. Instead, it unfolded like a change in weather, gradual, almost comforting. The trader began using derivatives tied not just to crude, but to volatility itself. Options layered on futures. Futures layered on swaps. Each position small enough to pass scrutiny, yet coordinated with unsettling precision. This was where the market's blind spot lived. Regulators watched for single massive positions. Exchanges monitored outright dominance. But they weren't built to see influence dispersed across instruments, jurisdictions, and counterparties. The trader understood that influence didn't require ownership, only timing and belief. As positions grew, the effects became harder to ignore. A modest trade executed during low liquidity hours would ripple outward by morning. Algorithms reacted first, amplifying moves. Human traders followed, fearing they were missing something fundamental. Prices climbed not because oil was scarce, but because confidence was quietly being rearranged. Investors began arguing on trading floors. Some sensed artificial pressure. Others dismissed the idea entirely. Too big a market, they said. No one person could move oil. Economists echoed the sentiment, pointing to global demand and geopolitical risk. The explanation felt safe, comforting. Governments, meanwhile, saw only outcomes. Inflation data ticked higher. Subsidy costs rose. Energy ministers faced questions they couldn't answer. In private briefings, analysts flagged unusual volatility clusters, but without proof, concerns faded into reports no one read closely. The trader watched all of this unfold without celebration. This wasn't about ego. It was about mastery. About learning how far sentiment could be bent before snapping. And with every successful cycle, the strategy grew bolder, testing not just the market's limits but its attention. Because soon, the distortions would become impossible to explain away. The moment the market realized something was wrong didn't arrive with an alarm. It arrived with confusion. Oil prices surged on days with no news, then collapsed after reports that should have sent them higher. Correlations broke down. Models failed quietly at first, then all at once. On trading floors, screens flickered red and green without logic traders could agree on. Large funds began losing money in ways that felt unfamiliar. Hedging strategies that had worked for decades suddenly amplified losses instead of containing them. Portfolio managers demanded explanations. Analysts stared at charts, circling anomalies, muttering about non-fundamental pressure. Still, no one named the possibility that frightened them most: deliberate distortion. Behind the scenes, the traders' positions had reached critical mass. The trades now shaped liquidity itself. By entering and exiting during key settlement windows, the trader could tilt price discovery just enough to pull futures curves forward or push them back. It didn't look like control. It looked like momentum. And momentum in markets attracts followers. Foreign markets felt it almost immediately. Asian refiners adjusted contracts overnight. European energy firms delayed purchases, waiting for stability that never came. Currency desks noticed something stranger still: oil-linked currencies moving before oil itself. A signal traveling faster than the commodity it was tied to. Journalists began asking sharper questions. Why is oil behaving like a speculative tech stock? One headline asked. Governments noticed too. Emergency meetings were called, not because prices were high or low, but because they were unpredictable. Volatility, not cost, was becoming the threat. For ordinary families, the instability felt personal. Gas prices changed week to week. Heating bills became impossible to forecast. Trust eroded quietly, not in markets but in explanations. And still the trader stayed invisible. Until one miscalculation revealed just how fragile the system had become. The unraveling began with a trade that was supposed to be routine. A familiar sequence, executed dozens of times before. But this time, liquidity didn't return the way it always had. Counterparties hesitated. Spreads widened. Algorithms paused, recalibrated, then overreacted. Within hours, oil prices moved violently across exchanges. Not a crash, something worse. A disorderly lurch. Analysts flooded terminals. Risk desks froze new positions. Traders shouted across rooms that suddenly felt too small. This wasn't speculation anymore. This was structural stress. Regulators stepped in cautiously at first, issuing statements meant to calm rather than accuse. But internal investigations accelerated. Data teams began layering positions across instruments, something they hadn't done in real time before. Slowly a shape emerged. Not a single massive bet, but a constellation of influence. The same fingerprints everywhere. Governments reacted unevenly. Some blamed speculators publicly. Others tightened reporting requirements overnight. Energy-producing nations grew defensive, insisting supply hadn't changed. Importing countries demanded explanations as inflation forecasts were rewritten. Investors were stunned, unsure how a market this deep could be tilted this far without anyone noticing. Hedge funds unwound positions at losses they didn't fully understand. Corporations delayed capital spending. Confidence, once shaken, didn't return quickly. When journalists finally broke the story, they struggled with the framing. This wasn't fraud in the traditional sense. No false statements. No fake barrels. Just exploitation of structure. Legal until it wasn't. Ethical until consequences became unavoidable. And at the center of it all was a trader who never once touched a drop of oil, yet reshaped its price for nearly a decade. The question now wasn't how it happened. It was what it revealed about the system itself. In the aftermath, silence replaced chaos. Trading volumes normalized. Volatility receded. On the surface, the oil market looked like it had healed. But beneath that calm, something fundamental had shifted. Trust, the invisible glue of financial systems, had been quietly damaged. Regulators released carefully worded reports. They acknowledged structural weaknesses without assigning sweeping blame. Analysts debated whether this was a failure of oversight or an inevitable outcome of modern markets. Investors adjusted models, adding new variables meant to capture behavioral distortion, though few believed they truly could. For ordinary citizens, the story never felt abstract. Higher energy costs had already passed through supply chains, embedding themselves into food prices, transportation fees, and household budgets. The damage wasn't catastrophic, it was cumulative. A slow erosion of purchasing power that no single policy announcement could reverse. Inside institutions, the mood turned inward. Risk committees questioned assumptions once treated as law. Executives asked whether markets still reflected reality, or merely consensus. Journalists revisited old headlines, realizing how often explanations had been wrong, not because of malice, but because the system rewarded simplicity over curiosity. The trader, now exposed, became almost secondary to the lesson. This wasn't the story of one individual's ambition. It was the story of a market designed to believe in scale as protection, and how that belief failed. Because if oil could be shaped this way quietly and legally, what else could be too? The deeper truth was uncomfortable. Modern markets aren't moved only by supply and demand. They're moved by structure, incentives, and attention. By who understands the rules deeply enough to bend them without appearing to touch them. The trader didn't break the system. They revealed it. Governments responded with reforms that sounded reassuring but felt incomplete. Reporting thresholds were lowered. Cross-market surveillance improved. Yet insiders knew regulation would always trail innovation. The next distortion wouldn't look like the last. For investors, the lesson lingered in a quieter way. Size didn't guarantee safety. Liquidity didn't guarantee fairness. And transparency, when fragmented, wasn't transparency at all. The oil market returned to headlines driven by wars and politics, but the memory of artificial movement never fully faded. In classrooms and boardrooms, this case became a reference point, not for scandal but for humility. A reminder that markets are human systems first, mathematical ones second. And humans, when they understand leverage, will always test boundaries. In the end, the most unsettling realization wasn't that one trader manipulated oil prices for a decade. It was that the system allowed it, because it was never built to imagine someone would try. In the end, the oil market didn't fail because of greed or conspiracy. It faltered because of assumption, the belief that size equals safety, that complexity protects against control, and that markets always reflect reality. This story reminds us that global finance doesn't move only through headlines or hard assets, but through quiet incentives and invisible structures that reward those who understand them best. Long after prices stabilize and investigations fade, the lesson remains: the most powerful forces shaping our world are often the ones we don't see, until they've already passed through our lives.